Right now, the entire investment management industry is facing a severe and fundamental architectural crisis regarding its climate data. For years, environmental, social, and governance factors have been treated as external datasets. They are purchased from specialized vendors, stored in separate siloed platforms, and consulted by investment teams only as an optional overlay. Modelers account for climate exposure by inflating the denominator, adding an arbitrary climate risk premium to the firm's weighted average cost of capital. This method introduces a critical structural flaw: double counting. If a localized climate scenario already reduces operating revenue or forces higher capital expenditure, adding a separate premium to the cost of capital prices the exact same risk twice. Second, it conflates local operational hazards with global systematic risk. A drought affecting one specific facility is highly material to that specific node's cash output, but it does not automatically increase the entire company's exposure to broad market volatility. Altering the discount rate is a blunt instrument. It mathematically confuses distinct operational constraints with general market risk, resulting in a mispriced firm. A mathematically rigorous architecture handles this differently. It translates operational climate constraints directly into the free cash flow to the firm, the numerator. To test this mechanism, we can look at the copper mining giant Antofagasta plc. The operational reality for this firm involves extracting massive volumes of ore in the highly arid regions of Chile. Physical water scarcity here is not a theoretical sustainability metric. It is a strict physical constraint on the copper tonnage they can produce. To value the firm accurately, these localized physical constraints must be converted into explicit, traceable variables within the mathematical model. This table outlines Antofagasta's simplified valuation. Unadjusted base case projects a terminal NOPAT over £1,300 million, yielding £15.45 per share. Now, applying severe physical risk, drought causes a 2% annual production decline due to water scarcity. This constraint restricts revenue. Terminal NOPAT drops to £898.1 million. Terminal value collapses, plummeting equity value to just £6.01, over a 60% destruction. The precise share price is secondary. What matters is the clean causal mechanism linking a physical weather variable to a strict financial outcome. A well-designed, robust valuation architecture proves, via strict mathematical mechanics, exactly how physical vulnerability destroys a firm's equity value. Calculating raw physical exposure is necessary, but incomplete. Modelers must also account for the actions corporations take to survive. This shows the inherent weakness of using static EV to EBITDA multiples to value companies navigating the climate transition. EBITDA deliberately omits capital expenditure. Compare two competitors generating identical EBITDA today. One has abundant natural water, while the other faces chronic drought, forced into massive infrastructure spending just to maintain current output. Relying solely on historical multiples embeds outdated environmental assumptions into the pricing and ignores the massive capital costs required for future resilience. Antofagasta is actively adapting to its environment by committing heavy capital to large-scale desalination and seawater infrastructure. This resilience carries an immediate financial penalty. The specialized infrastructure requires severe, near-term capital expenditure. We map this adaptation directly into the third column of the DCF model. A massive capital outflow is recorded under CapEx to fund the desalination plant. That initial cost suppresses near-term free cash flow, but secures long-term water access, protecting future production. Terminal NOPAT recovers to over £1,126 million. Terminal value climbs to nearly £20,000 million, pulling final equity value back up to £11.60 per share. Corporate adaptation is a core valuation variable. Models tallying climate exposure without costing the required infrastructure mathematically penalize the companies actively building necessary resilience. Running this methodology on a single spreadsheet is one thing. Scaling it across thousands of assets requires a macroscopic upgrade to the enterprise technology stack. This diagram outlines the required architecture. The base layer is data ingestion. It strips out generalized ESG scores and replaces them with raw operational data, localized hydrology, specific heat stress maps, and granular carbon price projections. The middle layer handles financial modeling. Here, explicit rules translate those physical constraints directly into cash flow impacts. Hydrology dictates volume constraints. Heat mapping dictates cooling costs. This replaces subjective analyst guesswork with hard logic. The top layer is portfolio optimization. Instead of receiving a single deterministic value and assuming it is fact, managers receive probabilistic distributions, showing how a portfolio's intrinsic value flexes under different physical and transition scenarios. This interconnected stack establishes climate analysis as a dynamic investment capability. Modern enterprise architects design the strict lineage between physical reality and investment value, moving past simple software integration. They must dictate a 5-step causal chain: climate reality, to scenario, to operational impact, to financial impact, to valuation. Every assumption passing through this chain must be completely transparent, explicitly versioned, auditable, and reproducible across the firm. Investment analysis now focuses on how climate alters corporate cash generation and intrinsic value, rendering the generic ESG score obsolete. The advantage in asset management belongs to those who build a valuation architecture that mathematically understands climate change.